Good afternoon, everyone, and welcome to our six-monthly webinar for our Emerging Companies Fund. My name is Damien Crowley, Head of Distribution for Pengana, and today Steve Black, one of the co-portfolio managers of the fund, will be providing an update for you on the fund. As Steve goes through the presentation, and he'll be talking to the slides in front of you, please feel free to submit any questions, and then Steve and myself will run through those questions at the end, and Steve will answer those. So thank you for joining us, and I'll pass over to Steve.
Thanks, Damien, and thanks for your interest in dialing in today. We'll move through this presentation quite swiftly, allowing plenty of time for questions, as we have only a 30-minute time slot. Now, the key takeaways on slide, let me get this working. Hang on. Okay, sorry. So slide 2 there, just as a reminder of the fund, we're now 11 years old. We invest exclusively in small industrial companies. Over the 11 years, we've delivered returns of about 14% per annum after fees, which we're very pleased about. And critically, we feel we've achieved this without taking unnecessary risks. So we do generally have a very risk-averse approach to investing, not only in the mining stocks, loss makers, or indeed very few cyclical stocks. The team, which is just Ed and myself, has been intact now for the full 11 years. Our process to investing hasn't changed, and critically in investing in small caps, Ed and I both have over 20 years' experience in this space. So the fund is bottom-up stock selection fund. We have a run rate over that 11-year period, which continues today, of approximately 7 company visits a week. And that is where obviously we're unearthing where our value add is, and unearthing companies that are mispriced due to the stocks not being well researched. The fund has a very strict policy in terms of its capacity. We currently sit at $650 million in size, which is about the 0.5% of the market cap benchmark, which we are targeting. And as we outperform, many of you will have enjoyed distributions every 6 months of around the 5% level. We'll look to continue to at 5% every 6 months if we're above that technical capacity of about $600 million. So the last 2 years, in aggregate, the total distribution, including capital returns, has approximated about 25%. So just over the page, the performance over 11 years. Pleasingly, as I said, the return has been strong in a fairly consistent fashion, and certainly through no help of the index. The index, the Small Ordinaries Accumulation Index, has delivered over 11 years in accumulation sense, as I said, is only at 2.7%, which is certainly not a great outcome for the small index. However, the performance has been strong in absolute sense, which is what matters to unit holders, and that obviously comes about through the alpha possibilities in researching this space. Most managers do beat their benchmark, as you know, in small caps, but pleasingly in the Mercer surveys we rank number 1 over 10 years, 3 over 5 years, and 2 over 3 years. So in all market conditions, we certainly we have a process that has performed good numbers results. The next slide is a chart tracking that performance over the 11 years. And it has been, as I say, quite consistent. The variation there from year to year is probably most explained by the state of the small miners and their performance in the first 5 years of that journey. They acted as a headwind for the fund, and then the last 5 years they've acted obviously as a tailwind as their prospects have dimmed. Over the page on market themes, I'll move through this quite quickly. We're having just come through reporting season. I think it's fair to say that the small industrial stocks, particularly in the cyclical space, so those exposed to the housing market, retail market, media stocks, traditional industries, they are struggling. The outlook is quite poor. Guidance comments have certainly not been that regular. Management around the boardroom tables are struggling to see a lot of growth in those markets, and understandably so, particularly as I think most commentators would agree the housing cycle, both in an activity and a value sense, certainly seems to have peaked and indeed may be now rolling over. And the wealth effect that results from that in terms of individual citizens not feeling as wealthy will obviously transpire into the retail space through less spending, particularly as it relates to housing formation, less purchases of electrical goods, brown goods, furniture, and so on. So, as I say, we have very little exposure to that. The mining service stocks, no exposure to that, and just generally I think the unsettled state of the market due to volatility sapping investor confidence, state of the political changes that continually occur in Australia with 5 leaders in 5 years, with only Greece having had more changes at the top, is certainly unsettled investors. That said, our portfolio is fairly and squarely invested in less volatile businesses, always has been, always will be, and today around 80% of the portfolio is invested in those long-dated defensive businesses where earnings aren't subject to the vagaries of the cycle. So with good franchise businesses where we can trust management. Bottom of that slide there, we speak to the M&A cycle. It's certainly starting to heat up, not surprisingly so, particularly from overseas suitors where the Aussie dollar having fallen has made certainly heightened their appetite for stocks like Beta. iSelect and Coffee are under takeover bid from these international players, and we would expect that will continue whilst the Aussie dollar is at these lower levels. So just moving now to a few themes occupying our minds. This next slide is just a reminder that the future leaders are truly start off as small emerging companies. Stocks like CSL, Computershare, Sonic Healthcare, Cochlear, Ramsay, the list goes on. They're companies that are now household names. They have very broad reach globally, very successful companies, and have in most instances been share prices have risen 30 to 40-fold over the last 15 to 20 years. And in fact, those stocks, we certainly enjoyed those gains in my prior fund at JB Weir as being key contributors to that fund's performance. The online stocks, somewhat similar. When we started this fund 11 years ago, online advertising represented about 5% of total advertising spend in Australia. Today represents about 55%. Stocks like REA, Car Sales, Seek, What If, they've all been very strong contributors to this fund over the journey. Not so much today. We don't own any of those. They've migrated into the mid-cap and large end of the market. But it goes to show that the real upside in terms of industry leaders, new innovation, and global reach comes from these small industrial stocks that we simply don't get from the broader market, particularly the top 50 companies. It's not a very well-known fact that of the ASX 200, 30% of those companies are banks by market capitalisation, and indeed of the market, the top 10 stocks speak for 50% of the market by size. So the broader market is not very well diversified by number or certainly by industry classification, and we would argue strongly that to gain that diversification you need to look further down the spectrum to the small caps where we have around 1,000 companies that we're continuing to trawl through, building a stock portfolio of 60 stocks. The bottom of that slide there critically is referencing to the payout ratios. I think as companies are struggling to deliver strong organic growth, they continue to hand back money to shareholders, and with bond markets behaving like they are, these share prices are being rewarded. I guess the caution here would simply be that we firmly believe a lot of these companies will start to behave like bonds as well. They're not necessarily going to be equity-like performances from here with such a strong payout ratio. And not keeping cash back in the business to reinvest in CapEx and future growth, whereas the small cap end of the market, stock payout ratio is 58%, and we're seeing a lot of that growth coming through in our projections for the companies we own. These smaller companies, they have less bureaucracy, they're not as, they have less layers of management, they have more of an entrepreneurial spirit, and we firmly believe they're the reasons these emerging companies will become future leaders. The next page is, it's a page we've aired before, but not for a long time, but it talks to why we continue to see strong alpha in this fund, and many of our peers similarly see good upside in investing and researching small cap stocks. It's looking at sell-side analysts and their number of stocks that are covered by industry market cap bands. So the CSLs, the BHPs, the National Australia Banks, very large companies, and obviously attract a lot of analytical focus from sell-side brokers, and they, as you'd understand, will be far more efficiently priced than the companies in the blue there, which is our sweet spot of looking at companies with market caps of less than $500 million. They're the companies that are we're going to find the next REA or the next CSL or Computershare. Another theme which is very topical is the IPO cycle. We're 2 years into that cycle now, and over the last 2 years there's been around 70 companies list on the market. The companies have all fallen into our space. There's not many mining stocks listing, nor is there large caps listing, so they're all mid-cap, small industrial companies, so we've seen all those companies. And somewhat surprisingly, the gain has been very strong. From issue price, the average gain is 41%, and that's the reason why these IPOs are still flocking to the market. We're certainly believing that the market is looking a little tired. The quality of some of the companies we're seeing at the moment, we're still seeing 3 per week, is certainly falling, and it's one of the reasons we're very cautious, and we certainly haven't got a strong representation of these stocks in our fund. The reason for that is that we are of the view that many of these companies have been have been dressed up and window dressed for float to maximise the extra price, principally for private equity firms, and then after a couple of years, when you start to really see the quality of these companies, the share prices start to wane. Interestingly, of those 70, the first 25 companies that listed, half of those are now underwater, and that's the point we're making, and why we're very hesitant and wary of investing in these companies at the point of listing. Recent listings that we have invested in, nevertheless, are Baby Bunting, Pacific Smiles, which is the dentist rollout business, and QMS Media, the outdoor advertising business. The telco sector has been a sector that has provided very rich pickings for this fund over the last 11 years. We have had strong and large positions in M2 Group and Vocus. Those stocks, we were the first institutional shareholder in both those companies. In M2, we bought that at 26 cents. It's now trading up towards $10. Vocus, we bought at 85 cents, now trading at $6.30. It's a good example of stocks we love to own. It's stocks that are under the radar, that aren't being well researched, and we can identify them early. By staying small in a funds under management sense, that's the main motivation for closing the fund and returning capital. So we can continue to find the next M2 and Vocus for the portfolio. Specifically as it relates to the telco sector, the reason these companies and many others have done well in the space is because not only is a sector growing above GDP, but the incumbent in Telstra continues to be both dominant but distracted and inefficient, making it a very easy competitor to take market share from. The smaller players also have the advantage of introducing new technology to the market, which the likes of Telstra, Optus, due to their legacy CapEx programs that they're trying to protect, they're not as likely to roll out that innovative software or innovative product to the market as quickly as the smaller players, so they won't embrace it as readily. Also, the sector is benefiting from, of course, being non-cyclical in nature. Your telephone or your broadband is generally the last thing you turn off if conditions are slowing down and businesses are struggling. So slide 10 there is just a graphical representation of what's talking about in Telstra sense. So their market share has fallen meaningfully over that time, with the smaller players of M2, TPG and iNet obviously benefiting from that market share loss. That's a trend we actually expect to not just continue but potentially speed up as the NBN's rolled out. Telstra has a lot larger cost to serve customers, particularly in the broadband space, than M2 and iNet, and that advantage, we believe, will mean in a level playing field sense when NBN's rolled out, that iNet, M2, TPG will be able to take further market share, or indeed increase gross margins if they don't compete on price. So the next slide is a slide looking at the tourism industry, slide 11, which we'll show you now. So that slide is this is a sector that after many slow years and where there was a headwind with the Aussie dollar where it is, has fast become a tailwind. No longer are people flocking to Bali. They're starting to consider Noosa and Port Douglas again, with the Aussie dollar having fallen back. It's a far cheaper destination for local Australian residents. But also, more than that, you've got a far greater interest from overseas visitors with the affordability coming about through the lower Aussie dollar. So the Chinese are now the single largest international visitor to the Australian market, having just passed New Zealand, and now around 88% of all international travellers to the Sydney airport are Chinese. That's important, not just because that trend is likely to continue, because there's a lot more slots available at Sydney airport for Chinese carriers. That's all occurred in the last 12 months. Chinese airlines are now flying direct to Sydney, that weren't before, but also the Chinese typically spend about 3 times as much as the average international visitor to the Australian market. So stocks like Mantra, which is the hotel operator, Sea Link, which is the ferry operator at Kangaroo Island and Stradbroke Island, Tourism Holdings, which is a New Zealand tourism operator, Webjet, the online booking site, they're all key positions in the fund that have benefited in the performance sense over the last 12 months from this dynamic. Hotel occupancy has improved dramatically over the last few years, and that's benefiting a manager, not just in a filling of the hotel room sense, but also as occupancy increases, prices increase. And we've all fallen foul of that with the Perth market. As occupancy reached 90% through the mining boom, you'd have to pay twice as much for a hotel in Perth and Sydney through that period. That's a trend we expect in Melbourne and Sydney in coming years. I won't dwell on this too much other than to say that this chart demonstrates the crossover there of growth, with inbound obviously being a lot stronger now than outbound, which helps these tourist operators. And in fact, outbound saw no growth in the month of August in Australia. Snapshot of the portfolio at the moment. As I said, the portfolio is about 80% invested in those stronger defensive franchise businesses with little cyclical exposure. M2 Group, Burson, the auto parts distributor business, Pacific Smiles, the dentistry rollout story. Very little cyclical exposure in the fund. Exposure we do have is through what we would argue the quality cyclical stocks, HFA, Magellan, IOOF. No exposure, as I said, to building cycle, mining services, very little retail. And the companies we do own, in an acquisition sense, we're very sceptical. It's certainly a high risk way to grow. We prefer to own companies that grow organically in a measured way. But those that we do acquire, that are very acquisitive, we prefer to own those that are buying IT platforms, plant and equipment, and less acquisitions of people and professionals who can often be disillusioned, disenchanted, and can leave businesses after they've been acquired. Some recent purchases, IPH Limited, which is the patent attorney business that helps overseas companies file their IP and trademarks. It's a 130-year-old company, very strong business. QMS Media, outdoor advertising business, as I said. It's the little brother of AP and Outdoor and Media, which you may have heard about. They're a lot cheaper and a lot faster growing. Tourism Holdings, the New Zealand tourism operator. Life Healthcare, which is the medical distribution business. Some recent sales there. ResMed has reached our price target and is now a top 50 company. Perpetual performed very well for us over many years through cost cutting and reinvigorated management. From here, they're looking to grow via fund flow. We think that'll be a little harder than perhaps what they expect. Slater and Gordon, let me come back to that in a moment. Recent outperformers in the fund have been Bellamy's, Veda, IPH, C-Link, and the underperformers, Treasury Group and Capital Health. So the next few pages, I've listed some stock stories here. Fair to say I'm not going to show you all the bad ones, just the good ones. This is a marketing presentation after all. But I think it helps demonstrate and the key message being that we look to identify these companies very early, before the market has, and certainly in a broker sense, and indeed before they go into the indices. And that gives them the next leg up in terms of a share price performance. HFA is a fund of funds business which we've been watching for many, many years. That's now a key holding in the fund. Magellan we identified nice and early. M2, as I said, has been a very strong success story for the fund, having bought that a month after we started this fund in November 2004. Pacific Smiles, a recent addition to the fund. And then Slater and Gordon, just finally, it's a good news story for us. We've enjoyed some very good share price performance here. As they entered the UK market, we started to wane in terms of our enthusiasm towards the stock. We thought they were taking a lot more risk than we were prepared to bear, so we started to sell as they acquired more and more of the UK businesses in the personal injury space. It's an industry that was undergoing major regulatory change in the UK. And then the last straw for us was when they announced the acquisition of Quindell, which was a very complex, large business that in itself had been cobbled together through rapid-fire acquisitions and questionable management practices. So we lost faith, it's fair to say, in the business. What had been a 100% personal injury Australian business when we bought it became 80% UK IP business when we sold it. And thankfully we sold out in the nick of time in mid-May before the share price collapsed. So just finally, before we open for questions, on slide 19 there is the current portfolio, the top 10 holdings, and also for the first time we give you a industry breakup and composition of the portfolio in terms of representation. We do like the fact that it is very diversified. So with that, we'll open the floor to questions if there are any.
There's a question from Martin Roach. Could you please give us further information about your recent underperformers, CAJ and TRG?
Sure, and it's a fair question. We're obviously, we make mistakes all the time. We're in the business of getting 6 or 7 stocks out of 10 right. That's why we own 60 stocks, and these are 2 stocks that have performed very well for us, but in recent times haven't. So taking them in turn, Capital Health is a stock we bought and identified at around 20 cents. It rose to above $1. We was fast approaching our valuation target, so we did sell some, but not enough. And it's trading back down now to about 60 cents. It just simply got overheated in the marketplace, and currently represents about 1% of the fund. Treasury Group, a little different. So Treasury Group it's probably jewel in the crown in our view, was Rare, and that was a portfolio or a fund that they recently sold as the principals decided to cash in their chips, and we agreed that with their approach they sold that business, but unfortunately what that meant was that they lost their best asset in our view, received a pile of cash, but we're not willing to give them the benefit of the doubt in terms of the deployment of that cash in the acquisition or seeding of a new boutique manager just yet. So we reduced our weighting in that stock, but the share price has also fallen.
If anyone's got any other questions, send them through. From Whitney Drayton, can you please explain how you stage capital with regard to initial exposure and core holdings?
With stocks that are IPOs, we for the reasons I highlighted earlier, we see them as high risk investment propositions. So we do generally have a lower initial weight in those companies until we get to know them a lot better. By definition, they haven't been lodging their accounts with the ASX year after year. We haven't had the comfort of meeting management numerous times. So there's always inherently a lot more risk investing in those businesses, particularly given we're a little cynical as to, in some occasions, the reasons they're listing. So we're a little more guarded. So we take certainly a smaller position in those. And then the other, probably better, the other good example is a company that has a very small market cap. Capital Health, for instance, when we bought into that, its market cap was about 25 mil. It was a very small holding because we're obviously not wanting to own the company. We want to keep the position and ownership of the company very small. As they grew through acquisitions, through capital raisings, we took advantage of that new issuance and built up our position in the fund.
Another question from Will Homan from Intest Financial Services. You acquired a stake in Blue Sky. What is your view on this company at this time? And also Steadfast. You have met with the company in the last quarter. View on the company?
Sure. So I'll take the last question first. So Steadfast we have. We've owned Ausbrokers for a long time. We don't own it at the moment, but it's in the same space in terms of insurance broking. It's a good business, a very good business. Our probably concern, which is something we're watching closely, is with the nature of how this business was strung together with all the member firms joining for the listing process. We're just preferring to probably wait 18 months, 2 years after listing to get an understanding of their behaviour, making sure they're sticky and prefer to be with this member group. And also they've made some recent acquisitions that are very large. We just prefer to see those settle. But that, plus also the insurance cycle, premium cycle, has softened. These cycles generally do soften for a 3-year period. We're only 1 year into that, so we're a little bit guarded because of that industry backdrop as well. Blue Sky is a company we have taken a very small position in. It's in the alternative funds management space. It's getting a lot of airway, that part of the market at the moment. The Future Fund has been very vocal on the need to have a diversified portfolio with a strong weighting to the alternative space, and Blue Sky are benefiting from that. They have a portfolio of very strong alternative assets, very diversified, and they're gaining a very good brand out in the marketplace. So it's certainly a stock that, as I say, has the makings of becoming very big over time. It's not without risk, and therefore our position is small at this stage.
Steve. This question from Dylan Mail at Simmons Partnership. Steve, can you tell us about QMS Media?
So QMS Media is, as I said, an outdoor advertising company. It is about a third of the size of the better-known APN Outdoor and Media, which have listed recently and performed very, very well. Similarly, QMS Media has performed very well. All three companies are benefiting from the conversion of static outdoor advertising sites to digital sites, where you can make up to 4 times as much money from these digital sites, which is why the conversion is occurring. Next year, approximately half of QMS's revenue will actually come from digital media. And they're probably our advantage, as we see it, of QMS over the other two players, which we haven't got an investment in, is that if the UK market is any guide, that conversion eventually gets eaten away by landlords who are renting out their sites, deciding to renegotiate better terms and share some of the spoils of that conversion. And so you've got to be very careful to look at the rental terms of those contracts, and QMS have far longer rental terms than the other two players.
Any further questions, anyone? Given there's no further questions, we might wrap up there. Look, thank you for joining us today. We'll be sending out an email with a link to the presentation, but obviously have a look through that. If you have any other questions, please call the business development team or myself or our client service team. Thanks again for joining us this afternoon. Thank you.